Okay, I call this meeting to order. Welcome to meeting number 141 of the House of Commons Standing Committee on Finance, and pursuant to Standing Order 108 Bracket 2 and the motion adopted by the committee on Monday, November 21st, 2022. The committee is meeting to discuss the report of the Bank of Canada on monetary policy. Today's meeting is taking place in a hybrid format pursuant to Standing Order 15.1. Before we begin, I'd like to remind all members and others in the meeting participants in the room of the following important preventative measures. And these have changed a little bit, members, through a message you would have received from the Speaker's office. To prevent disruptive and potentially harmful audio feedback, incidents that can cause injuries, all in-person participants are reminded to keep their earpieces away from all microphones at all times. As indicated in the communique from the Speaker to all members on Monday, April 29th, the following measures have been taken to help prevent audio feedback incidents. All earpieces have been replaced by a model which greatly reduces the probability of audio feedback. The new earpieces are black in color, whereas the former earpieces were gray. Please only use the black approved earpiece. By default, all unused earpieces will be unplugged at the start of a meeting. When you are not using your earpiece, please place it face down on the middle of the sticker for this purpose that you will find on the table as indicated. Please consult the cards on the table for guidelines to prevent audio feedback incidents. The room layout has been adjusted to increase the distance between microphones and reduce the chance of feedback from ambient earpiece. The measures are in place so that we can conduct our business without interruption and to protect the health and safety of all participants, including the interpreters. Thank you all for your cooperation. I'd like to make a few comments for the benefit of the members and witnesses. Please wait until I recognize you by name before speaking. For members in the room, please raise your hand if you wish to speak. For members on Zoom, please use the raised hand function. The clerk and I will manage the speaking order as best we can, and we appreciate your understanding in this regard. A reminder that all comments should be addressed through the chair. Now, to welcome our witnesses. With us from the Bank of Canada, we have Governor Tiff Macklem. Welcome, Governor. And joining the Governor is Senior Deputy Governor Carolyn Rogers. Welcome. And just before we hear your remarks, we do want to thank you for the kind invitation to join you at the Bank of Canada for a tour and an informal conversation. So on behalf of the members, we thank you for that. And members, you should all have received the invitation from the Governor. So on that, Governor Macklem, the floor is yours.
Well, thank you, Chair, and we are very much looking forward to hosting you at the Bank of Canada. I am very pleased to be here this morning with Senior Deputy Governor Carolyn Rogers to discuss our recent monetary policy report, as well as the monetary policy decision we took at our last meeting. So in April, we maintained our policy interest rate at 5%, and we published a revised outlook for the Canadian economy. We had three key messages. First, monetary policy is working. Total CPI and core inflation have eased further in recent months, and we expect inflation to continue to move closer to the 2% target this year. Second, growth in the economy looks to be picking up. We expect GDP growth to be solid this year and to strengthen further in 2026. And third, as we consider how much longer to hold the policy rate at the current level, we're looking for evidence that the recent further easing in underlying inflation will be sustained. So before taking your questions, let me take a moment to discuss recent economic data and our outlook for growth and inflation. Au Canada, la croissance a stagné durant la deuxième.
In Canada, growth stalled in the second half of last year, and the economy moved into excess supply. The labor market also cooled from very overheated levels. With employment growing more slowly than the working age population, the unemployment rate has risen gradually over the last year to 6.1% in March. There are also some signs that wage pressures are beginning to ease. Economic growth is forecast to strengthen in 2024. Strong population growth is increasing consumer demand as well as the supply of workers, and spending by households is forecast to recover through the year. Spending by governments also contributes to growth, and U.S. strength supports Canadian exports. Overall, we forecast GDP growth in Canada of 1.5% this year and about 2% in 2025 and 2026. The strengthening economy will gradually absorb excess supply through 2025 and into 2026. CPI inflation was 2.9% in March, and price increases are now slowing across most major categories. But shelter cost inflation is still very high and remains the biggest contribution to overall inflation. Looking ahead, we expect core inflation to continue to ease gradually. The more timely 3-month rates of core inflation are well below the 12-month rates, suggesting some downward momentum. But with gasoline prices rising, CPI inflation is likely to remain around 3% in the coming months. It is then expected to ease below 2.5% in the second half of this year and reach the 2% target in 2025.
Risks around our forecast. Inflation could be higher if global tensions escalate, if house prices in Canada rise faster than expected, or if wage growth stays high relative to productivity. On the downside, economic activity globally and in Canada could be weaker than expected, cooling demand and inflation too much. We don't want to leave monetary policy this restrictive for longer than we need to. But if we lower our policy rate too early or cut too fast, we could jeopardize the progress we've made bringing inflation down. Overall, the data since January have increased our confidence that inflation will continue to come down gradually, even as economic activity strengthens. Our key indicators of inflation have all moved in the right direction, and recent data point to a pickup in economic growth. Now, I realize that what most Canadians want to know is when are we going to reduce our policy interest rate? The short answer is we are getting closer. We are seeing what we need to see. We just need to see it for longer to be confident that progress towards price stability will be sustained. In the months ahead, we will be closely watching the evolution of core inflation. We remain focused on the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior as indicators of where inflation is headed. To conclude, we have come a long way in our fight against inflation, and recent progress is encouraging. We want this progress to be sustained. With that summary, the Senior Deputy Governor and I will be very pleased to take your questions.
Well, thank you, Governor, Senior Deputy Governor, and I'm sure the members have many questions. As you know, we start with the first round of 6 minutes for each party. We're starting with MP Hullen for the first 6 minutes.
Thank you, Chair. Thank you, Governor, Deputy Governor, for being here. Governor, it's my understanding that each central bank sets its own interest rates. Is there a global interest rate that would impact a Canadian mortgage?
Global interest rates do impact Canadian interest rates. Global financial markets are very integrated. In Canada, obviously, we're very integrated with the United States, so the interest rates in the United States have an impact on us. Because we have our own currency, because we have a flexible exchange rate, we can run our own monetary policy, so our interest rates in Canada don't need to be the same as the U.S. rate or global rates. But there is a limit to how far they can diverge. We're not close to that limit. We have the ability to run our own monetary policy geared to what Canadians need.
Okay, just on that vein, we see in the U.S. that the U.S. Fed has held the rate, and yesterday the Prime Minister said interest rates would come down. When you do cut the rate, whenever that does happen, What kind of impact does that have on the Canadian dollar if the U.S. market stays the same and the U.S. holds their rate?
Well, the Canadian rate is already below the U.S. rate. We're at 5. They're at 5.25 to 5.5. And it's hard. It's a little hard to say exactly what will happen on the day. It'll probably, on balance, weaken the Canadian dollar a little bit. But a lot of it depends on expectations. If you go back a few months, the expectation in the market was that the Fed might cut before the Bank of Canada. That expectation has shifted. To some extent, that's already built into the markets. So, yes, I think if we move lower than the Fed, that will tend to depreciate the Canadian dollar. That's partly how monetary policy works. A weaker dollar stimulates our exports, so monetary policy becomes less restrictive.
The Prime Minister said, like I said yesterday, that interest rates would come down. He was sure of that. But his housing agency is also saying, CMHC, that housing starts last year, this year, next year will all decline. In fact, CMHC is saying that we need 5 million more homes on top of whatever is being built. And the National Bank said Canadian households should not expect any significant relief from housing cost inflation. Now, when you lower that interest rate, what kind of impact is that going to put on housing prices, given that the demand has not gone down and it's only increasing?
Well, the housing market is very sensitive to interest rates, and right now the policy rate at 5% is restraining demand. It is making, obviously, the cost of a mortgage higher, restraining demand. If we lower interest rates, it will be less restrictive on housing, and other things equal, housing will tend to be stronger than it otherwise would have been. In our own forecast, we do have a pretty strong pickup in housing over the course of this year. We also have some increase in housing prices. We also expect that supply, while it isn't going to be able to grow quickly, we do expect supply will be growing gradually, and so the gap will be narrowing. But I would agree, it's definitely going to take some time to close that supply shortage.
Yeah, respectfully, Governor, I don't think you fully answered that. We're going to see a supply, we already have a supply shortage in housing. We see a rise in demand, correct?
Yes, we have a supply shortage, no doubt.
And according to CMHC, housing affordability will not meet what Canadians expect today. According to what you just said, would you have a timeline on, given everything, that all the numbers you have today, what kind of timeline are Canadians looking at for housing affordability to come back to what it used to be in Canada?
Well, look, I think housing prices have gone up a lot through the pandemic. They went up 50% in 2 years through the pandemic. They came down about 15%. They're back up somewhat now, so they're net down about 10%. We're not really in the real estate business, but our own forecast is that housing prices will continue to move up gradually. So I don't think you're going to see a big change.
Is there a fear of a cut increasing demand further? That might also push up the shelter inflation?
That is a risk. We do highlight that in our report. I think
is that more of a possibility than not, given housing starts are decreasing?
Well, in our forecast, as I said, we've built in a fairly strong growth in housing activity through this year, and we've built in some increase in prices. So, we've taken that risk on board in our base case projection. It could be even stronger than we expected, and that is a risk that we've highlighted.
Okay.
I just add that, the housing sector is an important part of the economy. It's an interest-sensitive part of the economy. It's certainly something we watch very closely, but we need to run monetary policy for the whole economy.
Thank you. Thank you, MP Hallan. And now we'll have questions from MP Baker.
Thanks very much, Chair. Governor, Senior Deputy Governor, thank you for being here at Finance Committee again. Governor, I'm going to ask you the question I ask you every time you come to committee. It's the question that I get asked by my constituents in Etobicoke Centre more often than any question when it comes to your role as governor, which is when are interest rates coming down? As you know, and we've discussed at this committee before, folks are struggling for a range of reasons right now. Cost of living is high, housing prices are high, but there are a lot of folks who have mortgages that are either they're on a variable rate or they're on a fixed rate, and now they've had to renew at a much higher rate, and that's been very, very difficult for a lot of folks to bear, and some have had to move out of their homes. Some have had to make significant sacrifices to make those payments. So that's the underlying reason that I'm asking this question. So I'm wondering if you could do your best to share with me, and I will share your response with my constituents, when are interest rates coming down?
Well, I appreciate you sharing the concerns of monetary policy decisions. So at our last meeting a couple of weeks ago, we did discuss when it would be appropriate to reduce our policy interest rate. And as I outlined in the opening statement, we were certainly encouraged by the progress. We do see renewed downward momentum in underlying inflation. For a while, it had kind of stalled. We do see renewed downward momentum. And if you go back to what we said in January and March, we indicated then we were looking for further and sustained easing in underlying inflation. And what we concluded a couple of weeks ago was that we have seen further easing. What we're really looking for now is for assurance that that is sustained. So the message to Canadians is we are getting closer. We are seeing what we need to see. And we just need to be confident that it will be sustained. We're very conscious that we don't want to keep monetary policy this restrictive for longer than we have to. On the other hand, getting inflation down as much as we have has been a hard-fought battle, and we don't want to cut too early or too quickly and jeopardize that progress. So we are trying to balance those two risks. We're going to take our next decision, I think it's June 4th, and then we've got another one in July, another one in September. We take our decisions at the decision date based on the best available information we have at the time. So I'm not going to predict what we're going to do at each decision. We'll do our best for Canadians when we get there.
I appreciate that. Can you talk about, when you say you're looking for signs that inflation is sustainably coming down before lowering interest rates, can you talk about what kinds of things you're looking at? Like, what are the kinds of things that Canadians, like my constituents in Etobicoke Centre, should be looking at to believe that things are heading in the right direction or not heading in the right direction? Because ultimately, they want to see you lower rates.
Yeah, it's a very good question. And so the first point is headline inflation, CPI inflation, is probably going, from month to month, it will bounce around. It's the latest reading is 2.9%. It probably will stay pretty close to that, around 3% for the next several months, because we know global oil prices went up. We know gasoline prices have gone up. And that has a very immediate effect on CPI. What we're looking for is when you strip out that, we want to see our measures of core or underlying inflation continue to move down. And so, watch CPI trim, watch CPI median. Those are our two preferred measures of core. In practice, those are our preferred measures for core for good reason, but we also look, there are other measures of underlying inflation, CPI-X food and energy, CPI-X. We also look at, in our monetary policy report, you'll see there's regularly a chart of the proportion of CPI components rising faster than 3%. When inflation was 8%, that was as high as 80%. The latest reading is 38%. Normal is about 25%. So we're getting down, we're not quite normal yet, but we're getting there. So what we're looking for, inflation to come down, for it to be less broad-based. We will be trying to look through the volatile components in headline. So try to focus on what we're focused on is the underlying measures.
Thank you for that. I have about a minute left, Chair. Okay. In your previous appearances here at committee, we've talked about fiscal responsibility and the role of fiscal responsibility in the broader economy and on cost of living. I saw after the budget was tabled, you made comments, I believe when you were at the IMF spring meetings, about the government's fiscal guardrails and how the budget committing to those guardrails is helpful. As we see core inflation continue to come down, can you expand on those comments about how Canada's fiscal position has not really changed since the budget was presented?
Well, the budget, so I guess the first point to make on that is the federal budget was tabled after our latest forecast, so it is not included in the latest monetary policy report. Most provincial governments had tabled their budgets ahead of our monetary policy report, so they are included in the forecast, and a number of provinces increased deficit financed spending. That is increasing, that is reflected in our forecast. It does increase the contribution to growth from governments overall, and increasing spending and fiscal deficits when we're trying to get inflation down is not helpful. The federal budget, as I said, is not included in our forecast. We will update our forecast in July and include it. Looking at the federal government, what you see is that spending is also up, and this is largely matched by an increase in revenue. Revenue is higher both because the forecast for growth is stronger, so that generates more tax revenue, and there are some new fiscal measures, the most important being or most significant being the increase in the inclusion rate on capital gains tax. The combined effect of those is that the fiscal track, by which I mean the track for the deficit to GDP and the debt to GDP, has not changed significantly from a macro perspective since the fall economic statement. And so, yes, I mean, we know different, we'll have to look at the various measures. Different measures have different fiscal multipliers, but at a very macro level, spending is, there's more spending going into the economy, there's more tax revenue coming out of the economy. The net effect from a macro perspective probably won't be that big, so I don't expect it'll have a material impact on our forecast.
Okay, thank you.
And with respect to the guardrails,
Yeah.
I mean, this...
We may have to go to the guardrails after Governor,
Okay,
just
fine.
because
I'm
we're
sure-
well over
I'm sure
time,
you'll-
and I
I'm
gotta
sure there'll
get-
be more questions on fiscal
we
policy.
have, who knows, MP Samari may be asking about guardrails. So, MP Samari, the floor is yours.
Oui, merci, Monsieur le Président.
Thank you, Mr. Chairman. Do I turn? No, it's already turned on? Okay. Ms. Rogers and Mr. Macklem, good morning. Thank you for being here. I'm sorry but we have a very strict chairman. He manages the time very closely. So I have questions regarding the last budget, so we might continue that on that vein. But first of all, I'd like to ask you something. You're often quoted at this committee concerning your analyses of the impact of the carbon tax on inflation. Last fall, you gave the example of Ontario when you came here and spoke about the impact. So I would like to ask you if it's possible to provide the committee with the results, according to your calculations, of the impact of the carbon tax on inflation by province. So that's something. Yes, we could do that when we assess the impact of this on inflation. As you know very well, the various provinces have different policies. They have different approaches. And so we do an assessment or an evaluation of the three most significant components by province. And we take that together in order to have an estimate for the country as a whole. So yes, we could provide the committee with our calculations per province, if you wish. Thank you very much. It would be greatly appreciated. I'd like to come back to the budget. If I understood correctly in your answers to Mr. Baker, overall, the assessment of the federal budget will be for the next monetary report in July. But at first blush, this might even go on to the fall because there are compensations with the revenues that have come in. Is that right? Yes, that's right. Okay. Yesterday, or shortly, we will be voting on the Ways and Means motion, and there's a measure that is going to affect the capital gains tax. Yesterday, the minister said that that will be in a separate bill, so we're not voting on that today. But if ever that wasn't presented at that point in time, we could expect to have an inflationary aspect of the budget. Is that correct?
Si tu enlèves une source de revenu, oui.
Well, if you remove one source of revenue, the deficit will be bigger, certainly. Okay, thank you. So I'll change subjects now. I'd like to hear you to speak a bit about the importance of the independence of the central bank in the management of its policies, particularly in an inflationary context. We saw the decision of the Fed, and many analysts said, oh, Joe Biden's hoping that the costs will go down before the campaign so that he can say, look what I've done, and that would give him a boost in the polls. So do you feel the same kind of pressures here? We know a lot of columnists and talk about the current prime minister and saying that he might resign and they have to have a leadership race. But would all of this be affected by these rates? So do you feel this kind of pressure in taking your decisions? And I'll come back to the issue of the importance of your independence in terms of monetary policy. Answer. First of all, the answer is no. There's a very good reason why we have an independent central bank, independent from the government, and it's exactly to avoid those kinds of issues. Monetary policy is something that is not, it goes through its cycle, it takes time, and it's important to keep moving in the right direction. And all of the big countries have an independent central bank exactly for that reason. So no, there's no pressure. I was very clear yesterday. Elections are elections. Monetary policy is monetary policy. We have a clear mandate, and we manage that to achieve the mandate. Thank you. I'll come back to certain exchanges you might have had at the committee on the other side with my colleague Clément Gignac, even if he's a senator. I find he has great qualities. Now, it's concerned the relationship between your policies here and the Fed in the U.S., because before the pandemic, they seem to dovetail quite well, but it seems that there's more divergence between the Canadian and American economies since. So I'd like to hear you speak to that, about the possibility of having a monetary policy that is diverging from the Fed's, and also the variation of the exchange rate within that analysis. Okay, well, first of all, it's important to note that our mandates are similar, that our economies are similar, and above all, during the pandemic, the shocks were very similar. And so the behavior of these monetary policies in both countries were similar. It wasn't exactly the same. As I said, the inflation rate was higher in the States than here, and the Fed funds rate was higher somewhat than that in Canada, but in general, it's quite similar. Over the last few months, we've seen more differences. And as I mentioned yesterday in the Senate, it seems that monetary policy has more traction in Canada, and there are several reasons for that. One is probably the fact we have a different structure in our mortgage market here than in the States. In the U.S., they have 30-year mortgages typically, and here it's often 5 years or less. So there are many more mortgages that have already been renewed here in Canada, and even for those who have yet to renew, it's not far off. So consumers will see that they will have to renew and they'll have to save more in order to pay down their mortgages. The other aspect is the household debt is higher in Canada. Households have a higher level of debt, and so the higher interest rates have a bigger impact on us here. We see that also in the growth of GDP. In Canada, it's been weaker than in the U.S., and so it's perhaps not terribly surprising that the inflationary tendencies here in Canada are lesser. So if the dynamic in our economy is different, then the monetary policy will be different between the two countries as well. Thank you. MP Sainte Marie.
MP Davies, please.
Thank you, Mr. Chair. Thank you, Governor and Deputy Governor, for being with us today. Governor, in its most recent deliberations, the Bank of Canada's Governing Council listed corporate pricing behavior as one of 4 key indicators of underlying inflationary pressures. In November 2023, in an article from CBC, you were quoted as saying, "When input prices have gone up, those are getting passed through much more quickly to final goods prices. So households are bearing the full inflationary impact much more than what that's what we can see pretty clearly in the data," end quote. In your view, Governor, why have increases in input prices been passed through to final goods prices more quickly in recent years than previous decades?
We've actually been doing quite a bit of work on this, and perhaps Senior Deputy Governor would like to comment on that.
There's, in fact, in our most recent monetary policy report, there's a box that goes into this in a fair bit of detail. Directly to your question, I mean, I think the reason that we saw companies were quicker and more inclined to pass through costs is because demand was high. And so they were able to pass costs through, and it wasn't affecting their sales. People were still paying. So, and that's, in an environment where inflation is high, that is one of the dynamics that we watch very closely. So as inflation is coming down, demand is coming down, demand is coming more in balance with supply. Companies think carefully about whether they can pass through their cost increases.
Thank you. In a February 2024 report, James Orlando, Director and Senior Economist at TD Economics, said this: "The Bank of Canada's inflation problem is mostly a housing issue. With shelter inflation accounting for more than half of overall inflation, this has become the biggest hurdle preventing the Bank of Canada from cutting rates." Governor Macklem, do you agree with that assessment?
I would agree that housing cost inflation is the biggest contributor to overall inflation. And it is certainly, it is an important factor that is holding inflation up.
So on that point, Stats Canada says year-over-year inflation, excluding mortgage interest, in March was 2%, exactly the bank's target. Higher mortgage interest has added close to 1 full percentage point to CPI inflation since last May. Is there something counterproductive in the Bank of Canada trying to reduce inflation with a policy tool that is increasing inflation by close to a full percentage point?
Well, if we hadn't raised interest rates, inflation and everything else would be higher, and overall inflation would be higher. We are well aware that when we raise interest rates, this increases the cost of borrowing. That is impacting Canadians. In fact, that's how monetary policy works, to restrain spending to get inflation and everything else down. The CPI includes mortgage interest costs. That is a major cost for households, and so it should be in there. But we're well aware that's the part of the CPI that we have the most direct effect on. When we raise rates, mortgage costs go up. That does, everything else equal, push inflation higher. So in the conduct of monetary policy, and we also know that when we reduce our policy interest rate, that will come down. So that is something that we can look through as we conduct monetary policy. And you'll notice we've talked a lot about how we're very focused on core inflation. And one of the reasons for that is CPI trim, which trims out the things that are going up the most and the things that are going down the most. It has systematically been kicking out or removing mortgage interest costs because it is up a lot. And so by focusing on core, we're effectively looking through the impact of mortgage interest cost on inflation. The other thing I would say about our measures of core, though, is that, our two measures of core, one's 3.1, one's 2.8, they're still well above 2. And what that's telling you is that, yes, if you just pull the thing that's going up a lot, mortgage interest costs, out, what's left is going up much more slowly, roughly 2%. But if you systematically take out the things that are going up and the things that are going down a lot, you're still well above 2%. So that's what we're focused on, is getting that down.
So I want to sort of some unintended consequences. We know that high interest rates have prevented many Canadians from purchasing a property. Obviously, if mortgage rates are high, they know as many people buy. People are telling me that's driving or keeping people more in the rental market. Would that demand for rental properties have anything at all to do with the rapid rise in rents?
Yes. Rents, there's a lot of pressure on rents. I think I would agree there probably is some effect. People that with higher interest rates are delaying buying a house need to rent for longer.
Yeah.
I think the bigger effect, though, is we've had a tight rental market combined with a big surge in immigration. Many of those immigrants are entering the rental market. We've seen a big increase, particularly in non-permanent residents. That is putting a lot of additional pressure on the rental market. And we have seen, rent inflation is around 8%.
Yeah, and I think CMHC is clear that they say that supply is not forecast to keep up with demand, leading to higher rents and lower vacancy rates in the coming years. Would you agree with that assessment?
I hope the gap narrows gradually, but yes, I don't think this is going to get resolved quickly. It's going to take some time to build new purpose-built rental. The other aspect that may take some pressure off is, as you know, the government has recently announced that they are reducing the number of non-permanent residents coming into Canada. We have included that in our projections. It was announced ahead of the budget.
Mr. Chair, do I have any time?
And so that should take some of the pressure off, some of the demand pressure off. But yes, it is difficult to forecast these things.
Thank you.
Thank you, MP Davies, and for the governor's sake, and Senior Deputy Governor, MP Davies is a new permanent member to our committee, and we also have P.S. Turnbull here on our committee now. So now we're going to MP Chambers we're in second round, members, for 5 minutes.
Thank you, Mr. Chair. Thank you for the work you do on behalf of Canadians. Appreciate you coming to committee. When you were here about 6 months ago, we talked about fiscal and monetary policy, and I believe you said that if the rate of growth in government spending could be at or below 2%, we'd be good. But spending growth next year for the federal government is 6.7%. So I'm not as steeped in economics, and I always learn something from you every time that you're here. I'm trying to understand how that is not inflationary pressure.
Okay, so let me back up a little bit. So first of all, when we're looking at, so that 2% number I gave you is real government spending on goods and services. It's not nominal spending. It's not public account spending. It's the national accounts measure of government spending on goods and services. So those numbers aren't directly comparable. What I can say in terms of our projection, so why do, if governments are not increasing their deficits and government spending is growing around 2%, potential output, the economy is growing about 2%, so government spending is not adding more to demand than supply is growing. So it's roughly
Okay, I'm going to jump in right there if that's okay. So expanding the deficits is expansionary fiscal policy, correct?
Correct.
In the last year and a half, the government has added net, not gross, net new spending of $100 billion to the fiscal framework. That's all deficit financed. Is your testimony that we are no longer in an expansionary fiscal environment?
My testimony is that the fiscal situation, this budget relative to the fall economic statement, the deficit to GDP, the debt to GDP track has not changed significantly. So I don't expect it's going to have a significant macro impact relative to our previous forecast. So in other words, I don't think the federal budget is going to have a big impact on the forecast that we published
Okay,
a few weeks ago.
so would you say now that fiscal and monetary policy are rowing in the same direction?
I would say, overall, coming back to our forecast, the impact, so in most of the provinces tabled their budgets ahead of the NPR. They did increase spending, and it was largely deficit financed. That has increased the contribution to growth from government. So last time I was here, I think I said government spending on goods and services this year was forecast to grow at about 2.25%. That has now moved up to 2 3/4. That is somewhat above 2%. So yeah, that is not helpful in trying to get inflation down. It is built into our forecast. We still get inflation back to the 2% target. It does get there gradually. The final thing I'll say is there are a number of risks to our forecast, and we highlight those in the back. To the extent that the federal government sticks to its fiscal guardrails, the risk on government spending is managed. We see some bigger risk to our inflation forecast coming from geopolitical events. Others have mentioned the housing market. We think those are bigger risks.
Thank you very much. That's very helpful. I know you mentioned before that we could take a calculator and do it ourselves, but I'd certainly appreciate the bank's model or how it's looking at government spending, because you can understand how it's a little bit confusing. But I'll move on to my last question.
And we can talk to you offline about that.
That's
to
very
be
helpful.
honest,
but I just have one more question, Governor.
Quite complicated.
All tax increases are not the same with respect to inflation. So I'm trying to think about the capital gains tax, where you pull forward a bunch of transactions that would have happened in future years. And that movement of money, where someone turns an asset into cash, creates a big cash balance in a new person's bank account. That movement of money, is that not an inflationary pressure, even just a little bit?
Well, as I said, we're going to have to go through the budget a little more carefully. There are also, on the spending side, there are a number of new spending initiatives, as you've highlighted. Those will have different types of fiscal multipliers. So, for example, military spending that is mostly importing, say, U.S. machinery is not going to have much inflationary impact in Canada.
I'm out of time, but I will look forward to your capital gains.
I'm getting to capital gains. I think so all to say, we need to look at the various measures more carefully, and we will do that getting to July. My analysis at this point is very macro. There's more spending going into the economy. The government's tax measures are pulling more money out of the economy. So from a macro perspective, the net effect isn't that big from an inflationary point of view.
It's pulling money out, but money that wasn't going to be brought out anyway because the assets weren't going to be sold. Anyway, that's a bit academic, but maybe we could talk about that offline.
It's taking money out of the private sector into the government.
Thank you. Okay. So thanks, MP Chambers. We are going to MP Ed Zerowitz for the next 5 minutes.
Thank you so much, Mr. Chair, and I want to thank the Governor and the Deputy Governor for being here today. I'm going to start off with the residents of my riding of Davenport and what I'm worried about with them. You have been very consistent about how core inflation has to be sustained for a long period of time. You've come before our committee so many times, and I've listened to a lot of your speeches. You've been very, very consistent. What I worry about is that in living memory, my constituents remember a time for 10 years where interest rates were abnormally low. If you look at actually the whole span of history, actually it was a very abnormal time period. And I feel that when we're talking about, so whether you do it in June, whether you do it in the fall, and we start sort of reducing the interest rates, I'm worried that the perception that constituents of my riding, Canadians, will have is we're going back to what was an abnormal interest rate level for a long period of time. Can you maybe speak to that? Am I having should they have that expectation, or should they be given a bit of a reality check?
Look, we are concerned about that too, and in fact, I think you gave a whole speech trying to outline the reasons why. I mean, first of all, interest rates are certainly not going back to the emergency low levels we had during COVID. They're unlikely even to go back to the pre-COVID levels. As you said, we had, from the global financial crisis to COVID, we had an unusually long period of very low interest rates. So yes, we're probably not going back to those types of interest rates. The other thing I would say is, in our own forecast, once we become more confident that the downward momentum we've seen in core inflation is going to be sustained, so we are solidly on a track back to 2%, it will be appropriate to lower interest rate. And we're going to take each decision at a time, but when you look at our forecast right now, inflation's coming down pretty gradually. So even when we start reducing interest rates, it's likely to be a pretty gradual path. So, for both those reasons, the longer term and the shorter term, yes, I think Canadians should not be expecting that we go back to pre-COVID levels of interest rates, and they shouldn't be expecting a rapid decline in interest rates.
Okay, thank you for that. As you know, our government takes climate change seriously. We have a very strong climate plan to decarbonize and to move to net zero by 2050. In your last appearance at committee, you confirmed that the annual increases in carbon pricing raise the average economy-wide price level by 0.1 percentage points. And you also said this is fairly negligible compared to other determinants of inflation. What happens is, we sort of said 0.1 percentage point. Canadians don't really understand what that means. Like, they don't know, does that mean that's $200 extra a month for me, or whether it's $2 extra for me? So maybe if you could first just confirm whether it is negligible, and what you maybe define it for the average Canadian who might not understand what 0.1 percentage points negligible would be according to StatsCan CPI calculations. So maybe if you could address that, please.
Well, I can follow up, if you like, with some more representative calculations. But so the contribution of the carbon tax, the government has laid out a schedule of increases of the carbon tax. So we can build those into our forecast. And yes, they have an impact somewhere between 0.1 and 0.15 percentage points on inflation. So the latest reading for inflation was 2.9%. If the carbon tax had been held constant, had not raised up, it would be closer to 2.8% instead of 2.9%. So, I mean, what that means is, yeah, I can give you some representative calculations if you like but it's a small number.
Like,
I mean,
yeah, I just wish there was a way for us to say it, because when the Conservatives say it, it makes it sound like it's a big number. When we say it, we said, well, it's negligible because the governor says it's negligible. So for us, so I just would say to us.
I'm not putting any adjectives on big, negligible, small, large.
Yeah.
I'm just giving you a number.
No, but what it's
you can decide.
No, but unless there's a way to actually further define it for Canadians, it's very hard to understand whether it's big or small. I'll keep on going, Governor. My next question, it continues on the price on pollution, which we also call the carbon tax. The Conservatives have also argued that if we eliminate the carbon tax or the price on pollution, it would bring inflation back within target. It would then lead you to cut rates and turn easing the pain Canadians may be feeling. Am I correct in saying that eliminating a price on pollution would not lead to price stability in the economy?
It's always a little dangerous getting into things that haven't happened and things that could happen. But in general, if there is a tax change, so if you were to if the carbon tax were to be eliminated, that would have a one-off drop on the price level. So inflation would drop for 1 year, and then after that it would go back to where it otherwise would have been. And monetary policy needs to be forward-looking. We know that that's a very temporary mechanical effect, and so we would tend to look through that. If you want a good example historically, in 1994, the government cut the tax on cigarettes in half because there was a big smuggling problem and they needed to equalize it at the border. That had a big effect on inflation. Inflation was roughly 2% ahead of the tax cut. It went to 0 for a year, and then a year later it went right back up to 2. Now, from a monetary policy respect, we knew the tax. Once the tax cut was announced, you can see the impact on inflation. We know a year later that's going to fall out. So effectively, we look through that.
Okay, thank you.
Pete Zerowitz, and now to MP Sainte-Marie.
Thank you, Mr. Chairman. Mr. Macklem, in your comments, you said that you expect to see an increase in the CPI of some 3% from the first half of the year and 2.5% in the second half of the year, and 2% rather for 2025. And following that, in your comments, you said you had to take into account fundamental inflation in your analyses. So, can the central bank begin to decrease its policy interest rate to reach that 2% level? Yes. I have often said that. There's a certain delay between changes of interest rate and the effect on inflation, and that's why we are really focused on our forecasts for inflation. And so when we're confident that it's clear that we are on track to get to 2%, that will be the moment to start to decrease that rate. Monetary policy will remain tightened or restricted, but not so much as today. We want inflation to stay at 2%. We don't want it to go below 2%. But if we leave it at 5%, then for too long that will happen. Thank you. In your presentation, you said that there's excess supply currently in the economy. Is that correct? Now, when the supply is in excess, won't that have an effect on that policy interest rate? So aren't you being perhaps too cautious? Well, different people will have different opinions on that, and as to whether the decisions we took were appropriate. And we look at several indicators. Yes, we think that overall the economy is moved into excess supply. In the first half of the year, it was close to 0, so demand has caught up to supply. And this is an important reason why we're seeing less pressure. We think that this year growth will be stronger than last year. So supply and demand for this year will grow at about the same rate And so that gap will remain the same. Next year, it will decrease. So that's one of the indicators that we look at for inflation to see where it's headed. It's not the only one. We look at salaries. We look at salaries as compared to productivity. We look at inflation. We look at how businesses set their prices. All of these indicators are moving in the right direction. A few are moving faster than others. And that's an important reason why we are more confident that we're on the right track. Thank you. Thank you, St. Marie.
Thank you, Governor. I want to close off my question on housing. It appears quite clear from the numbers that rental construction has declined since rates started rising. We know that if interest rates are higher, people aren't buying as many, but it also affects construction companies' decision to build. What, in your judgment, has been the impact of higher interest rates on residential rental construction?
I mean, certainly higher interest rates are one of the costs that goes into housing construction. So yeah, it has been lower. There's been a number of incentives introduced to try and build back that construction. So certainly, I mean, monetary policy has had effect on housing starts. We have seen that.
Thanks. I want to turn to unemployment. In a speech in November 2022 to the Public Policy Forum, Governor, you said that Canada's unemployment rate, which was then 5.1%, was too low. Now it's 6.1%. I'm curious, I'll give you a suite of questions. Is unemployment too low today? What is your unemployment target? How high does unemployment have to go before you think it's too high?
Well, let me first be very clear. We don't have an unemployment target. We have an inflation target. Our mandate is to control inflation. We look at the labor market really through two lenses. One, the labor market is an important indicator of the degree of excess demand or excess supply in the economy. When I made those comments, the economy was clearly very overheated. The labor market was overheated. There were widespread reports from businesses that they couldn't find the labor they needed. Wage growth was picking up. Those are all signs that the labor market was out of balance. Since then, the unemployment rate has risen from 5.1 to 6.1. In practice, we look at a broad range of labor market indicators. We actually have on our website, we have this all quite laid out in some detail. And you want to look at vacancy rates, you want to look at the employment rates, participation rates, you want to look at men, you want to look at women, you want to look at youth. So when you look at them all together, what you see is a labor market that has certainly moved into better balance. We're also starting to see wage growth, which has been too high relative to productivity, start to moderate. So those are all signs that inflationary pressures should be coming down.
You kind of anticipated where I'm going next. Do I have time for more? So I want to talk about productivity. Deputy Governor, you said when you compare Canada's recent productivity record with that of other countries, what really sticks out is how much we lag on investment in machinery, equipment, and importantly, intellectual property. Now, I've done some research, and spending on machinery and equipment by businesses and R&D and innovation has been falling as a share of GDP in Canada for many years, actually dating back to the beginning of this century after the corporate tax cuts that Paul Martin introduced. It's kind of ironic because those corporate tax cuts were supposed to spur more business investment, not less. But even though we have rapid job creation, population growth, business capital investment has not kept up. I'm struck the C.D. Howe Institute did a comparison of the U.S. In 2014, investment per worker in the U.S. was $20,700. It was $14,400 in Canada. And in 2023, the U.S. has gone up to $27,800. We're at $14,500. We've gone up $100 in 10 years. So could you outline what strategies could be more effective in increasing capital investment in Canada, given that the entrenched trickle-down theories like tax cuts for corporations and the wealthy clearly haven't worked as intended?
So MP Davies, I'll just say that's a great question, but I need a super short answer, and there may be more because we're well over the time, but there will be an opportunity kind of in that final round also to follow up on that. But if you want to like a condensed 20 seconds.
I can be quick because I mean the way I would answer you is you've outlined the the problem very well. You've been clear that it's stretched over time. It's stretched over different tax regimes. So I mean, what that tells us is there isn't a single clear solution. There isn't a magic, a magic measure that's going to fix this. It's going to take more than one thing. We're not tax experts. We're not even productivity experts. I'll leave it there, Chair. We can come
Thank
back.
you,
I'm sure
Senior
we'll come
Deputy.
back
I'm
to
sure
that.
you'll be able to elaborate in like the next round, but we're going to MP Morantz now for 5 minutes.
Thank you, Mr. Chair. Governor, always a pleasure to see you. Let me ask you a pretty straightforward question. If inflation today was 2, 2.1, 2.2, instead of 2.8, 2.9, would that make your job easier in terms of a decision to reduce the policy rate?
If we thought it was going to be sustained at that level, absolutely yes.
Yeah. Okay, and just earlier in this meeting, you testified that the incremental increase in the carbon tax from $65 to $80 represented 0.1% of inflation, and that if it hadn't happened, inflation would be 2.8, correct?
Correct.
And when you were here in October, you testified that the overall effect of the carbon tax at $65 a ton was 0.6% of inflation. Is that correct?
Correct.
So the combined effect, to be absolutely clear, today is that at $80 a ton, the carbon tax contributes roughly 0.75% to inflation, correct?
That's not quite accurate. It's to the rate, what matters for inflation is the increase in the carbon tax. So that's the 0.1 to 0.15. Yet you are correct that if the carbon tax was eliminated, yes, there would be a drop in the price level of about 0.7. So for 1 year, inflation would be 0.7 percentage points lower.
On that talking point about 1 year, I just want to correct that as well. It's 1 year in perpetuity. You can only eliminate the carbon tax once.
Right.
So my question to you is fairly simple. If the carbon tax were repealed, which is what Conservatives will do when we are in office, and it were repealed in April, would that have been helpful in your decision to reduce interest rates and as a result help millions of mortgage holders in Canada reduce their payments?
Well, as I said before, if as you just said, if you eliminate the carbon tax, you can only do that once. So it'll drop inflation for 1 year by our estimate about 0.7. A year later, inflation will go back up 0.7 because the once-off decline in the price level will fall out of the rate of change calculation. So in terms of monetary policy, I mean, we've had tax changes like this in the past. I mentioned the cut in cigarette taxes in 1994. Changes in GST have a similar 1 year effect. Those are things we tend to look through. In fact, one of the measures of core we typically follow is something called CPI ex food, energy, and taxes for exactly that reason, because we want to see what we're focused on is the underlying trend in inflation. I mean, this conversation is
Governor,
a little
sorry,
hypothetical,
I've just got limited time. If you could just
I'll leave
answer the question, if the carbon tax were eliminated, would that make your job easier in terms of reducing?
inflation would be lower for 1 year, but it would not be sustainably lower, so I don't believe it would have a big impact.
Yeah, okay. And I want to circle back to this issue of the delta between, and I realize you said we have flexible monetary policy in Canada, but there is a limit, which you said yourself.
Yep.
How big can the delta be? We already have a weak dollar at 72 cents. It's way too low. I just had a meeting, for example, with the Canada Food Grains Bank in Winnipeg last week. All their contracts are in US dollars. They feed the poor in countries all over the world. So this has real life impacts on people, life or death impacts the Canadian dollar. That's just one example. So how far are you willing to go to jeopardize the value of the Canadian dollar?
Look, our flexible exchange rate works well. It's what allows us to run a monetary policy that is geared to Canadians. I'm not going to draw a line in the sand. Clearly, if we cut interest rates and that weakens the Canadian dollar, that is something you take into account with how much you need to reduce interest rates to get the same amount of monetary policy stimulus. So it is certainly something we're going to take into account. But
10 seconds.
you know, the whole reason you have a flexible exchange rate in our own currency is so that we can gear monetary policy to the needs of Canadians, and that's what we intend to use that system to the benefit of Canadians.
Thank you.
Is that it? Yeah.
Yes. Thank you, MP Moritz. Now we are going to MP Thompson for the next 5 minutes.
Thank you, and welcome back to committee. And actually, thank you for the clarification on the pollution pricing and the carbon rebate. I cannot call it a tax. I'd like to stay on climate change if I could, and I believe it's my topic the last time that you came to committee as well. But given that climate change is becoming an increasing force in the economy, or a major factor in the economy, and this can also lead to increased supply disruptions, I'd like to focus on this for a moment. In previous appearances, you stated that you were working on building a model on the effects of climate change into your main macro models or economic models. Has there been any progress on this front? And if so, I'd really be quite interested in hearing.
Yeah, we are continuing our work on that. One of the difficult things about using models for climate is most of our models and that help us forecast are based on history. And so the difficult thing about climate change is really we don't have that kind of data from history to use. So what the Bank of Canada and other central banks are doing is making good use of scenario planning, or looking at different scenarios, using some of the climate science data to project what a future effect would look like. But we are trying, we're going through a large exercise at the Bank of Canada right now, looking at our models. We're taking on board a lot of the things we've learned over the last few years. It's been a challenging time for central banks' ability to forecast for a variety of reasons. But one of the things we're really working hard on is trying to incorporate the effects of climate risk on the macroeconomy. So.
Could you speak with a little more detail on what those climate risks are, or what that looks like?
Well, I mean, a big one is supply shocks, as you said.
Yeah.
So that would be one element. We look at transition risks, so changes in relative asset prices. Would be two good examples.
Roughly, there's two types. There's physical risks, so flooding, forest fires. Those obviously have very direct impacts on people, on their livelihoods. They also disrupt transportation. And then there's, as the Senior Deputy Governor said, transition risks. I mean, the economy, we're going to need, we're going to have less fossil fuels. We're going to have a lot more electricity. That's going to, that's just one example. There's some big adjustments that need to take place. How are those going to play through in the economy?
Thank you. And very quickly again on risk, in your opening remarks, you mentioned one of the variables in terms of the economic forecast is global uncertainty. Could you speak to that? I mean, quite briefly, but in terms of the impact on where our uncertainty in projections in terms of the real variables, rather than, we tend to be very micro when we talk about it here at committee, but I'd be more interested in your thoughts.
Yeah, I mean, the geopolitical risk usually translates into changes in assets that are priced globally, so a lot of commodities. I mean, the increase we've seen recently in oil is a result of some of the geopolitical tension that we have in the Middle East right now. So that would be one risk. The other way it would translate could be supply disruptions. If you have disruptions to trade agreements, that can have big effects on supply and on prices as well. So.
Thank you. I'm going to actually share my time with my colleague who would like to just add a point to her questions.
Thank you, Joanne. Just, Governor, you had very kindly offered to follow up with calculations when I was saying, can you sort of give us a little bit more details around the annual increase of carbon pricing and the being around 0.1%? If you could do that, we'd be very grateful.
Happy to.
Thank you. That's it.
Okay, are you guys good? Yeah. All right. You still have 30 seconds, but we will, you do have a quick question? Sure.
Quick question. I just reference, go back to the reference on guardrails. I don't think that you ever had the opportunity to expand on that, but I think it's important in terms of understanding your comments and outlook and where Canada sits in terms of our economic forecasts.
Well, I think I was largely done, but I mean, the guardrails in particular, keeping the deficit and the debt on a downward track, and in particular, I think it's been very helpful to not only put a number on it, but put a date on it. That becomes a more a target with a date that you have to achieve it becomes a more meaningful target. So the objective to have the debt to GDP deficit, to GDP ratio declining and below 1% in 26-27 and thereafter, I think that commitment is helpful in that it gives some clarity about the overall path for fiscal policy. From a monetary policy point of view, I think it mitigates the risk that large government spending will throw inflation off track.
Okay, thank you. Okay, thank you, MP Thompson and Pete Zarowitz. Now, members, looking at the time, we're going to divide what time we have left equally. We're going to go with 4 minutes for each of the parties. We're starting with MP Lawrence for this first 4 minutes.
Thank you very much. Thank you, Governor Macklem, for being here, and thank you for your availability. Who sets the interest rate for Canada?
The Governing Council of the Bank of Canada.
Right. And you're supposed to do that independently?
Yes.
Okay. At the end of question period, Prime Minister Trudeau yesterday said, and I quote, that and interest rates will be coming down, I'm sure, in the coming months. Have you communicated to the government that you'll be reducing interest rates?
Look, I have regular conversations with the Minister of Finance, but no, I don't. We take our decisions when we take our decisions, and I communicate that decision to the Minister of Finance after we've taken the decision.
So there's no way that the Prime Minister could know that interest rates are coming down?
We haven't taken the decision yet, so.
So there's no way that he would know that interest rates are coming down. Why would he say that?
I think you should ask the Prime Minister that question.
I think we will. I think it's exactly what we're going to ask that. Don't you think that's an irresponsible comment of him to make?
I think you should take this up with the Prime Minister. I'll leave it at that.
Okay. I want to talk, I'm going to switch gears and just talk briefly about, with Ms. Rogers, if that's okay, about productivity. I agree with you in your speech on March 26th, of which you said this is a breaking glass moment. I want to talk about one particular factor. I know that there are many. You talked about it a little bit in Canada, and you talked a little bit about it in your speech. When you talked about capital investment and the lack of capital investment. Canada is, of course, predicted to be dead last in the OECD. And so we need capital. We need capital to maintain and increasing and to improve our productivity, to grow our economy, and to fight inflation. Is now the time to increase taxes on capital?
Well, as MP Davies pointed out, we have seen declining capital investment over a long period of time and over multiple different tax regimes. We're not tax experts. So we're not going to evaluate any one particular measure. What I would say is there's really three things that go into productivity. There's labor, there's capital intensity, and then there's basically a multiplier in terms of how effectively we use those other two things. our productivity problem spans across those things. Capital intensity, capital investment is one of those things, but we have room to improve in all three areas.
Yeah, it makes sense, though. Presumably, and some of the issue, I think, is competition. Otherwise, why that investment is not being used by businesses. And I think Mr. Davies makes that point well. But if, in fact, we reduce the amount of pie, we take more money from the private sector and give it to the public sector. If, in fact, Canadian businesses have less investment, less capital, we're going to be less productive. It's basic economics.
Is that a question?
Yes. Or you can get a statement. You can disagree or agree. Sorry, go ahead.
At a basic, so at a basic economic level, that's true. As I said, there's three things that go into productivity. And we have room to improve on all three things. I talked about all three of them in the speech. Investment's one area.
Another issue in your excellent speech, Ms. Rogers, you talked about was the difference in sort of cultural or societal, sort of that entrepreneurial spirit that experts have commented that the Americans seem to have more than Canadians. One of the things that I'm very challenged by this NDP Liberal government is their demonization of entrepreneurs and of success and of business owners. If, in fact, you hear things like business owners are cheats, if in fact you hear more and more this sort of class warfare, eat the rich type of commentary from the NDP Liberal government, I'm not worried so much about those who are already prosperous, but what I am worried about is those who want to desire to be wealthy. And I don't think that's a bad thing. In fact, I think that's a great thing. If in fact we undermine young Canadians' dreams to become wealthy, to become successful, do you not believe that that has the effect of undermining our productivity?
I think Canada has a lot of entrepreneurial spirit. We have a strong education system. We have a lot of the factors that should set us up well to improve our productivity. I'll leave it at that.
And now to P.S. Turnbull.
Thanks to Governor and the Deputy Governor for being here today. Good to see both of you. And so I want to pick up where my colleagues left off and ask about climate change and the impacts on our economic growth. Do we have any idea at this point on the impact that climate change is having on Canada's economic growth? I would note that the Canadian Climate Institute did a really good report called Damage Control, where they modeled this, and the numbers were pretty scary, to be honest. I mean, but I wanted to ask you, Ms. Rogers.
Yeah, I mean, as I said earlier, one of the difficult things about climate change is that we don't have a long period of history with which to forecast the effect. And really the impact on the economy is from events, right? So it's really what we think of as shocks. So that can have effect on growth. I mean, you saw the effects if you looked at GDP in British Columbia, you saw the effects of the forest fires last summer very directly, right? So if in order to really think about the effects on the economy, you have to sort of forecast what we anticipate some of those shocks to be, how much more frequent they'll be, what's the scale, that kind of thing.
So is the challenge really not having climate science integrated enough in terms of your macroeconomic models?
I think that's one of the things we're working on, is trying to take some of, take what we've learned about the impact of these shocks and forecast them on a go-forward basis.
And is
But-
the
Just underline.
Yeah.
It is to interject here, members and witnesses. The bells are ringing. I'm just looking for UC that we can continue. Okay, we have UC. Okay, go ahead.
Typically the way we have an economic model and we estimate it on historical data. So, for example, we've raised and lowered interest rates many times. So we can empirically estimate if we raise interest rates, this is what it does to the economy. If we lower interest rates, that's what it does to the economy. We haven't had climate change before, so it's very hard to come up with good estimates. So we're really relying, and if anybody, says they've got a forecast of exactly what the cost is going to be, frankly, I think you'd want to be a little bit skeptical. Probably the best we can do is do some scenarios, give some range of the costs. We are working on that, but it is somewhat outside of the way we normally do things, because we normally use the past fluctuations to estimate what we think will happen again.
I understand that the climate risks and the frequency of those extreme weather events are hard to predict because they haven't happened in the past as frequently. Certainly, climate change has been, it's not a news story today. I mean, it's been going on for 30 or 40 years or longer. But I guess what I'm trying to get at is there's quite a lot internationally of focus on the fact that climate change, in fact, threatens our economic stability. And so I wanted to ask you about that. How is the Bank of Canada, and in terms of your role, how are you thinking about how we mitigate that risk from an economic stability perspective?
So I guess just to be clear, the Bank of Canada does not have a mandate for climate policy. We are not, our mandate is solely monetary policy, controlling inflation, trying to mitigate vulnerabilities in the financial system. So climate change is, it's a huge force on the economy. It's going to affect the economy. It is already affecting the economy. And what we're focused on is working out the implications of that for inflation, what that means for monetary policy. So we're not in the business of trying to estimate the overall impact of climate change on the welfare of Canadians.
I think the one thing I would add is if you think of climate risk as the risk of shocks to the economy, one of the things you can do is create more buffers. So in the financial stability world, we're asking financial institutions to hold capital or buffers against those types of risk. At a broader economic level, this is one of the reasons we think productivity needs to be a focus. The more productive the economy is, the more buffer it has to shocks, including climate risk shocks.
Yes, Turnbull. Now to MP Sainte-Marie, please.
Merci, Monsieur le Président.
Thank you, Mr. Chairman. The policy rate is at 5%. Does the bank assess what a neutral rate would be? Well, we have estimates on the neutral rate, and I want to emphasize that it's something that's quite theoretical. This neutral rate is the policy rate, and it's what happens when the economy is well balanced and inflation is at 2% and there are no shocks. That's the only thing I can tell you that I'm certain of, is that will never happen. There will always be new shocks, but it's a concept. We have to have such a thing in our model, and in the spirit of transparency, in our estimate of the neutral rate, once a year we review our forecasts of the neutral rate and also what the potential rate might be for the economy. And after that, we increase it by 25 basis points. So it's a range between 2.25 and 3.25. So the middle would be 2 3/4. Okay, I just want to emphasize that it's not something that has a great deal of impact on our monetary policy, because it's really a long-term concept. In the short term, our focus really on the measures that we've already discussed. Okay, for how many months has it been since you raised interest rates in order to counter inflation? Answer, I don't understand the question. How many months has it been since you raised that rate, the prime rate? I think the first increase was last July. But the first, not the last one. Oh, the first one was in March, 18 months ago, roughly. Okay. Because here I want to refer to the Berkeley economist, Eichen Green. He says that in the past, high increases in prices have contributed to managing inflation. He said that there is it has taught us the importance of central banks. So following the management of these kinds of hikes in inflation, and he said it's important to see these and central banks have establish these priorities and to present this to the public. So today, do you see lessons emerging from this that flow from this current inflationary period? Yes, Barry Eichen Green is an economist who looks at history. And recently, I wrote an article for CPR. It's a chapter in a book. And also, I gave a few speeches. Towards the end of last year, I gave one. And it reflects on the lessons of this recent period of inflation. So it's a whole chapter. I don't have time to describe it all, but I think that there are a few important lessons to be drawn. One of the most important, and it's already been mentioned by this Deputy Governor, when the economy is in excess supply, the effect of shocks of supply are much more significant. So we've had these kinds of shocks of supply over the last 20 years, but the effects, most of the time, were transitory. So that's the word, transitory. But, or rather, therefore, when we've seen shocks, we think that they will be transitory at first. But the fact that the economy was in excess supply, we saw that those shocks had a much greater effect on inflation than in the past. So that's one lesson. And I think perhaps the most important lesson, and it's not necessarily a new one, but it's a new experience, unfortunately, for many Canadians. We haven't had inflation, significant inflation, since many years, since the 1970s and a bit more in the 80s. And so for many Canadians, it's the first time they've really experienced inflation. And what we've not so much learned as, can you say relearned? What we've been reminded of is that Canadians don't like inflation. It's very divisive. It creates an impression that the system's not working. It's working hard. They're working hard, but their dollars buy less. Thank you.
We are going to MP Davies, and you'll be our last questioner, MP Davies. I just want everybody to hold tight because then we're going to have to transition to our other meeting. So just if everybody can stick to your desk. And okay, so we've got MP Davies now for 4 minutes.
Thank you. Ms. Rogers, I realize you're not a policy source for how to deal with productivity, but you did raise in a very profound and important way the issue of productivity in Canada. I want to press something. And that's, I was asking about the relationship between a policy of corporate tax cuts that were supposed to spur more business investment. And in your answer, you said that this problem has persisted through different tax regimes. But for the last 20 plus years, corporate tax rates, the policy in Canada has been to keep them low or to reduce them. There has been no reverse policy of increasing corporate tax rates. So would you agree with me that one thing that we can probably predict is that a long-term policy of low corporate tax rates has not proved particularly effective in incentivizing business to invest in R&D and innovation and technology?
I think what I would be inclined to agree with is the first part of your statement, whereas this has persisted over a long period of time.
But the same
and
tax
different
policy.
regimes. Again, we are not tax experts. It's not our job to evaluate the effect of tax policies yet.
Thank you. Governor, gasoline prices I want to talk about for a moment. They've spiked in recent weeks in most parts of Canada for several different reasons. Can you estimate the impact of these higher gas prices on year-over-year CPI inflation for April and May? And do you think that higher gasoline prices are a reflection of excess demand in Canada's domestic economy? I mean, will interest rates in Canada bring down the price of gasoline?
Well, the short answer to your second part of your question is no. I don't think this reflects excess demand in Canada. I think this largely reflects the global price of oil. You've seen, particularly given the tensions in the Middle East, this is creating uncertainty in global oil markets. You've seen the global oil prices go up, and that gets reflected very quickly in gasoline prices at the pump. In terms of the contribution that's likely to make for inflation, it's really the increase in gasoline prices is really why we think headline inflation is going to remain around 3% for the next several months, even as we continue to expect underlying or core inflation that strip out those volatile components to continue to gradually tick down as we have seen it do in recent months. So obviously, at the end of the day, our target is for total CPI inflation. That reflects the cost of living in Canadians. That's what we're committed to getting back to 2%. But global oil prices can be volatile. They go up and down with geopolitical events and other events. So we tend to look through those and focus more on underlying inflation. So, I mean, in terms of the message to your constituents, we're really focusing on looking for that sort of continued gradual downtick in core inflation.
MP Davies, and on that we want to thank Governor Macklem, Senior Deputy Governor Rogers. Thank you for coming before us with your report from the Bank of Canada on monetary policy and answering the many questions from our members. Also, members, the Governor and his office has sent out an invitation. If you can RSVP back to the Governor, and that will be so that we will be touring the Bank of Canada in June. So on that, thank you, Governor, and we wish you the best with the rest of your day.
Opportunity, and we look forward to seeing as many of you as possible at the Bank of Canada.
Thank you. Okay, and members, we are in a suspended mode right now. you.